Good morning. I'm Afsaneh Beschloss, CEO of the RockCreek Group. I'm delighted to be here this morning with Dr. Alan Greenspan, very well known to our audience for many years as, of course, longest serving chairman of the Federal Reserve, but also extremely well known as the author of a number of books, including History of Capitalism, which we hope Alan will talk a little bit about later. We're also very fortunate that Sebastian Mallaby is in town and could join us today for a discussion. Sebastian has been very kind to advise RockCreek from time to time, but also he is a senior fellow at the Council for Foreign Relations and also writes for the Washington Post and a prolific author and thinker and economist and many other things. So delighted to have you here and so glad that we could get both of you in the same room to talk, given everything that is going on. Last time we had this this meeting, we had Liaquat on, and Alan and Liaquat were saying that there is no trade war at that point. It was June 9, in fact. We're at a very different time. At the same time, in the last week or two, we have seen a lot of pieces talked about and written about the 10th anniversary of the financial crisis. And we have a lot of other interesting things going on in the global economy, between the US economy, UK, of course, about which Sebastian has written a lot, and emerging markets. So if I could just start with the 10th year anniversary and where we are today as compared to where we were prior to the crisis. What makes you feel better about what has happened over the last 10 years, and what are you still worried about, Alan?
What makes you think I feel better, period? No, as I indicated subsequent to the crash, which actually nobody foresaw. I mean, there's a lot of people around who have been saying this for years and years. You see, I told you so. Yes. But I did a piece for the Brookings in which I went through all of the various different blockages that were supposed to protect us, and they all failed. And the trouble with that is that we haven't changed anything. I say in the new book coming up, something which I've been arguing for increasingly for years, is that what we really need to do is to recognize that there really is no non-financial sector and financial sector. It's that difference which is creating a real problem, because we are saying that financial system needs less capital than the non-financial system. That's where our problem lies. If we had, for example, for financial intermediaries, a equity requirement as a percent of assets somewhere in the area of 30–40%, which incidentally is the average of a goodly part of the so-called non-financial sector, there are very few contagious failures in the, so I would say, non-financial sector. And the reason is that that buffer is sufficient and has been over the decades to block any contagion. But what we have found repeatedly, and it climaxed in 2008, I would say in a manner which is going to come back and hit us again, which was essentially that we created a system which had too narrow a buffer. And when you went in, for example, when Lehman, the day before Lehman declared bankruptcy, it had 3% tangible capital. Now you can go through 3% tangible capital in about 10 minutes if you're slowing down. And what we've got to do is to avoid contagious crises. And the only way to do it is to create a big block of equity capital for a financial intermediary. To which all of my banker friends says, well, that will cut down on lending. And I say, it'll cut down on some lending, but you shouldn't have lent to those people in the first place. But the real issue is that what is not the case is that a large equity requirement will somehow stifle the organization.
Sebastian, what are your thoughts?
I apologize for taking too much time.
No, this was very interesting.
Well, I completely agree that there is no good reason not to want financial intermediaries to hold more equity capital. It's just a better buffer than borrowing all your money. Now, the problem, it seems to me, is institutional. That there was a moment when Timothy Geithner became president of the New York Fed, wanted the banks that he was supervising to hold more capital, checked in with the chairman, who said, yes, good idea, you should do that. But when you tried to push more capital into the banks, the risk moved out of the banking system into the non-banks. Mm-hmm. And that is a problem we still have, because financial regulation in the United States remains balkanized. There is supposedly now the FSOC, the Financial Stability Oversight Committee, which is in theory coordinating, but is a fairly weak coordinator. So you still have a lot of non-bank mortgage origination, accounting for more than 50% of new mortgages, which is not supervised by the Fed. And there are all sorts of other intermediaries which don't come under sort of the kind of high-quality supervision that banks are subject to. So my worry now is that, we already have improved the amount of tangible capital in the banks. We've improved their liquidity. But if you were to do more of that, the risk would simply flow into less regulated parts of the system, and the problem would crop up there.
I mean, we've seen in our day jobs at RockCreek and other firms see this also. A lot of capital has moved into private lending, which is essentially doing the same things. We see a lot of venture firms financing these new mortgage entities that look at credit differently, actually much more innovatively, but also are providing mortgages and other kinds of loans. Last but not least, of course, is what has happened with student loans, which have ballooned since 2008. That's something that we had in 2008, but obviously student loans are much, much bigger today. And they could impact the economy in a very different way because it impacts the behavior of the future generations.
Yeah, but what I'm arguing for is that there are mandatory requirements for a financial intermediary. And I would not distinguish a financial intermediary very significantly from any other corporate entity. Right. And I wouldn't mind just having regulations stipulating that any corporate entity which essentially lends to others is required to have X%
the same
of equity to assets. Right. And I think this solves that problem. Now, it will not solve the sound of noise of the bankers. When I wrote this up, this was several years ago, in the Financial Times op-ed, I heard from a few of my friends. And I said, what part of my argument do you disagree with? And that's not, I didn't get, coherence was not what happened in the conversation that occurred thereafter.
Right. China has been a much bigger topic, and depending on the day, markets have got impacted negatively or positively by the news or the tweets of the day. What are your thoughts, Sebastian, on what's happening on this so-called trade war and where we may be headed?
Well, it waxes and wanes, and I think we're actually on a waning path right now. If you take the three areas of dispute, you've got the US versus Europe, right, which has been de-escalated. You've got the US driving a rethink of NAFTA. The Mexicans have signed on, And I would be very surprised if the Canadians ultimately don't, because they would suffer a lot. I think there are conditions the Canadians want in terms of protecting their domestic cultural industries and farm subsidies, but I think they're going to have to join the NAFTA. So that'll solve that issue. You're left then with the big US-China fight. But at the moment, at least, the idea is there'll be more talks before the second tranche of American sanctions are activated. So we'll see how that goes. And obviously, this is a highly unpredictable White House. And, Georgia can be followed by war. But I think even if there was an outright, an escalation of the sanctions, the effect on US GDP, the estimates I've seen are on the order of 10 basis points of lost growth. For China, it might be 20 basis points of lost growth, particularly when the US is actually growing way above potential. I don't think there's a near-term big cost. I think the cost is more politically in terms of businesses' faith in the settled nature of the trading system. The idea that you can reopen everything. I mean, there's, I think, quite a lot of research showing that it's not so much just the level of tariffs that matter for business, it's the certainty of tariffs, and that's what we are sacrificing stupidly.
And it's the uncertainty that has increased.
Exactly.
So.
Yeah.
Well, I think it's important to change our terminology and substitute the word tax. What a tariff is nothing more than a tax. It could be an excise tax, and indeed, it has exactly the same effect. And what caused a problem in the United States is because when the Constitution set us up, we had no sources of revenue because income taxes were illegal, other forms of taxes were illegal. So what they did is the revenues that originally set up Alexander Hamilton's basic structure of finance were tariffs. And that became sort of, throughout the United States history, the major source of revenue for everything. And it sort of came as to, well, that's the normal thing. Well, it isn't the normal thing. What Ricardo, very famous British economist, demonstrated, as did many of his colleagues, is the equilibrium levels. The ideal amount of tariffs globally is 0. The reason is, to the extent that it is other than 0, you're reducing the effect, you're reducing the interaction of various different societies so that their unit costs, or rather, those with the lowest unit costs and therefore prices get the business, and those who don't or go elsewhere, so to speak. But what that does is it optimizes the aggregate global GDP. And so when we talk about this issue of China and the United States sticking very large tariff tags on each other, what they're doing is that they're withdrawing purchasing power from the global system. And it affects both parties negatively. The only question is when we, for example, talk about, well, we're going to raise these tariffs to protect ourselves against China, who is paying the tab? American citizens. And nobody, especially those who are in charge, understand it. They do not understand double entry bookkeeping. Right. They do not understand how the markets function, and that when you get into a discussion on tariffs, interaction between countries, you're merely trying to say who's going to get hit the hardest, and they try to get the least impact. And it's unfortunate that that's the way those things run, but I think psychologically they were sanctioned by the American Constitution as something that not a bad thing to do. It's a terrible thing. I can't think of any saving grace that I can imagine I would attach to it.
With regard to China specifically, it seems like the bigger issue has been the issues around intellectual property versus, not that trade is not an issue, but that somehow has disappeared from this discussion.
Well, the intellectual property is called theft.
Right.
Now, there are laws.
I was trying to not use the word.
I find myself at a loss when people change terminologies as though it changes the world. It doesn't. It's just renames certain things in certain manner. First of all, the issue between China and the United States. Remember that China's per capita GDP is a third of ours. And even though they're running ahead, their growth rate is tremendous, they are still a very shallow economy relative to the United States, even in our debilitated state as we are at the moment. And if you're going to say it's going to be a war between China and the United States, we'll win. But it's not a win, it's we lose less than China loses, so to speak. And that is an unideal way, if I can coin a phrase, to hold international negotiations.
Especially right now with President Xi feeling a little weaker, as there's a lot of, seems to be discomfort around his own leadership and questions about his own leadership. Sebastian, do you think he'll be more worried about his local audience and how they feel he's posturing versus the US? Will that matter in all of this, or really will they stay with the 100-year vision of China?
So I think in a sort of short-term way, Xi has two vulnerabilities. One is that by Chinese standards, the Chinese economy is growing less quickly than normal. I think growth is just over 6%. It managed a kind of average of 10% for a 10-year period a few years back. Yeah. So 6% is kind of at the low end of what they want to tolerate. As you know, they were trying to cut down the leverage in their system in the last year or two for the good reason that they had two financial mini crises, and they want to build more resilience. And I think one casualty of a trade war is that they're going to calculate that they need to reactivate the credit machine to boost domestic growth to make up for any loss on the trade side. So I think, it is hitting China at a moment when Xi is maybe less balanced and less confident than, but in a sort of longer term way, I think he's very confident. I think he's consolidated power in a way not since Mao Zedong. And he's using his power and China's accumulated savings to exercise influence through this Belt and Road policy, which is essentially a way of using credit to gain leverage over other countries. It's interesting right now in Zambia, they're probably going to have a debt workout, not with the IMF, but by talking to the Chinese and offering the Chinese control over their infrastructure. So I think, he's in a strong position. He recognizes that Trump is a geopolitical disaster for the United States, and he's trying to fill that space and exert more Chinese influence. And I think he's in a weak short-term position on the trade issue, but in a strong longer-term strategic position.
Interesting. sort of going back to the U.S., what has been going on in the U.S. is obviously we've also been growing, not at much better rates than before. Nothing like in China, of course, given where we are on our GNP. But employment has been going up by quite a bit the last few years, and we hit the lowest unemployment rates recently in 20 years. But wage growth seems to be still stilted, and we see that some companies are providing benefits, education, health, school, other kinds of benefits, but wages seem to be not going anywhere. Is that going to change, Alan?
Eventually, certainly. The one thing that puzzles me about the most recent 20 years or so is that the inflation rate has been so negligible. One of the aspects that I've learned going back in time in the United States is that the inflation rate defined in terms of gold units, even now, is remarkably stable. And as a consequence, what you realize is that it's not an exactly flat thing, that there's a process by which adjustments are continuously taking place. And I think that's what's going on here. That is, at some point, the inflation rate and nominal wages will be rising at a significant pace. And I am puzzled at the moment as to why it's been so delayed. But that it eventually will occur seems to be inevitable if history is any guide.
Right.
And I'm still waiting.
Sebastian, any thoughts on?
Well, I think that we might look back at the 70s and say the anomaly was the 70s, that period of a high propensity to generate inflation because of regulation.
Are we talking about the stagflation period?
Yeah. That was an extraordinary period when it was very easy to generate inflation because of labor market rigidities, lots of regulation, fairly strong labor unions, relatively closed economy by today's standards, maybe a bit less technological change. And now we're back in a zone where all these forces are restraining inflation. As in fact, you wrote in your last chapter of your autobiography, as I recall, that globalization and technology.
The original one?
Yeah. Yeah.
2007.
I still remember it. It made a big impact on me. You argued that both globalization and technological change were restraining inflation, and I think that remains even truer today. Notwithstanding all this trade tension, we have more integration in terms of the volume of global trade. And so I think that's why, that's a big reason why the system hasn't generated inflation recently.
The fact that interest rates now seem to be, going up on more measured increments, and Chairman Powell recently in Wyoming said that he's navigating by the stars, I think was the term he used. Do you see that meaning things are going to be more predictable or less predictable moving forward?
I'm happy that it means less predictable. So I think that there was a period when forward guidance was embraced with excessive enthusiasm by the Fed. Forward guidance, it seems to me, is a great idea when you're in a slump and you've already cut the short-term interest rate as much as you can because of the zero lower bound, and you're trying to guide down the longer-term interest rates by telling people what your policy will be in the future. But when you're out of that slump, then telling the markets too clearly what you're going to do in the future is not only wrong, because as Stan Fisher, the former vice chairman, once said memorably, central banks shouldn't tell people what they're going to do in the future because they don't know what they're going to do in the future. But in addition, you just don't want the markets to be complacent. You don't want to give a false sense of assurance that you can leverage up your balance sheet because you won't be surprised by an interest rate hike. And I think that in saying that, he's going to be guided by the stars in a slightly mystical way, Chairman Powell is signaling that, he's watching and waiting, and he doesn't have a crystal ball and it's a bit murky and he's navigating with some difficulty. And I think that confession of humility and also that policy will kind of be decided as you go along, those are good things.
Alan, do you have any thoughts on navigating by the stars or any of the other?
I have not commented on Federal Reserve policy.
I know
in
you're
so
very
long,
careful.
I've forgotten what it was.